happy to have you here, Rick. So this is the first time that we're going to be running this type of sessions here in Mexico. And so how's the weather over there? And you're in Silicon Valley, okay?
It's a little warm. Climate change is found us today. So I came in with a jacket. I go, no way, this is not going to work. So we're a little bit more casual, but otherwise,
Oh,
yeah, nice and sunny, beautiful. Thank you.
yeah. And so last week you were in Brazil, so you were enjoying some caipirinhas, dancing some samba, I guess. So you're stepping your moves.
Oh, you don't want to see me dance samba, no.
No?
That's not,
Okay.
it's not a good look. But it is winter there, so
Yeah.
Southern Hemisphere, so we got a chance to see
Yeah.
it. Yeah, so it was kind of nice to take a little bit of a break. Sao Paulo, beautiful city. I'd never been. Largest city in the Southern Hemisphere, 20 million people, and it was just spectacular. But it is nice to
It's
be home. Thank you.
yeah, it's crazy. Yeah. Okay, so let's see. We already have most of the participants here, and just I'll be switching between Spanish and English during the session, right? So I know that your Spanish is
Un
great, I would
poquito.
say. Un poquito? Yeah, I know. So, okay, so in any case, if any of the participants has any doubt, you can either write something in the chat, either in Spanish, English, and we can help with the translation.
Okay.
And we have also Rodrigo here. So, Rodrigo, gracias por invitarnos a esta sesión. Te cedemos, si te parece, el micrófono unos minutos.
Muchas gracias, Javier. Muchas gracias, Rick, por lo que nos vas a compartir. Bienvenidos todos. Estos minutitos son para platicar lo que hacemos en Game, quiénes somos. Entonces, esto me tardará un momentito nada más. Nosotros somos el pionero en inversión ángel en la ciudad. Lo que hemos hecho hasta ahora es invertir por ahí de 15 compañías. Nuestro objetivo al final es potenciar emprendedores de toda Latinoamérica para que desarrollen modelos de negocio escalables. Empezamos por ahí del 2008, nuestras participaciones o nuestros intentos, y eventualmente se acumularon 15 empresas en dos fondos distribuidos por completo. El tercero lo acabamos de levantar y estamos activos buscando oportunidades. Entonces, bienvenidos los proyectos que nos quieran presentar. Hemos sido muy afortunados en el trabajo y en el hallazgo de muy buenas compañías hasta el momento, gracias a que tenemos un proceso, creo que yo, muy institucional y muy disciplinado, que puede llevar de 2 a 3 meses. Estamos trabajando a que esto sea más rápido, pero para los emprendedores que están aquí, más o menos para que vayan conociendo nuestras etapas. Nuestra tesis de inversión es modelos de negocio que sean escalables, exclusivamente que sean modelos de negocio escalables, idealmente que tengan una validación comercial y operativa, es lo que nosotros buscamos, emprendedores que trabajen tiempo completo, y buscamos invertir en cada ticket inicial algo entre 50 y $250,000. Más o menos con estos primeros puntos podríamos empezar a tener conversaciones con cualquiera de ustedes y conocerlos y subirlos a nuestro análisis de deal flow. Hasta ahora hemos invertido, como les decía, en 15 compañías. Resumo nuestro fondo uno. Los primeros dos son fondos institucionales, fondos que a nuestra vez nosotros invertimos. También invertimos en Bill Pocket y Quesky, que son creo que las más conocidas del Fondo uno. Playing Prestari son dos compañías que ya no existen, desafortunadamente. Boxfeed es un marketplace de influencers, y Wavemax es una compañía que da internet en sitio como Soriana, etcétera. Con una tecnología de hiper localización con beacons. Nuestro fondo 2 ya ha invertido en 7 compañías distintas. Local Adventures, que es un marketplace de experiencias. Flex Club, que vende coches en un método de suscripción. Credfit, que da factoraje, lo que conocen del servicio de factoraje financiero, pero en línea. BuyPrice te entrega el fármaco o tu medicina hasta tu domicilio más barato. La Pieza es un headhunter digital. Era Diagnostics es una empresa que detecta de manera temprana el cáncer cérvico-uterino. Y Confi Abogado es un servicio legal. En particular, hoy damos el servicio de la asesoría de despido, por la demanda de despido injustificado, atendemos al empleado. Encontramos una manera de hacerlo de manera automática, aprovechando pues todos los beneficios de la tecnología que tenemos el día de hoy a la mano. Y aquí pueden tomar mis datos, este es mi celular y es mi correo electrónico, entonces pues yo feliz de mantener el contacto y ahora sí, bienvenidos a la sesión.
Muy bien, pues muchísimas gracias, Rodrigo. Y bueno, nuevamente, pues más bien me presento por primera vez. Formalmente mi nombre es Javier Sevilla, soy de la empresa Novarec y en la sesión de hoy vamos a estar platicando sobre temas que están alrededor del mundo de las startups. Y iniciamos esta charla hace algunas semanas, ¿verdad, Rodrigo? Pues comentando de que creemos que es interesante que en ecosistemas como Latinoamérica, pues contribuyamos a que pues tanto fundadores como inversionistas, sobre todo inversionistas de primeras etapas, pues entiendan tal vez los fundamentos de cómo funciona, conceptos, términos que se utilizan en el mundo de venture capital y que van a estar siempre presentes en el mundo y el ecosistema de las startups. Entonces, con esta idea es que decidimos hacer esta primera sesión, donde vamos a hablar precisamente de términos básicos, fundamentales, que vamos a tratar de estar estableciendo como que las bases y los pilares, para que pues probablemente ustedes también entiendan estos primeros principios que van a ayudar a entender de mejor manera pues cómo pueden tomar mejores decisiones y cómo funciona este mundo. ¿Ok? Y para esto decidimos que nos acompañara en esta sesión alguien que forma parte de nuestra red internacional. Pertenecemos a una red que se llama Strategy Tools, que tiene base en Noruega. Y bueno, tiene gente que está alrededor de todo el mundo. Y para eso invitamos a esta sesión a Rick Rasmussen, quien nos está acompañando de Silicon Valley. Y mencionaba también hace un momento que vamos a estar cambiando entre inglés y español a lo largo de la sesión. Así que siéntanse en libertad pues, de interactuar en cualquiera de estos dos idiomas. Y él nos va a estar ayudando, va a estar compartiendo pues parte de lo que él ha visto, lo que ha experimentado. Él ha estado en 3 equipos directivos de 3 startups que salieron a bolsa. Entonces, conoce muy bien cómo funciona esto. Es también parte de el faculty de diferentes universidades en Estados Unidos y está pues siempre colaborando pues en diferentes regiones, ya sea con aceleradoras, con firmas de venture capital, quieren lanzar nuevos probablemente fondos con agencias nacionales de innovación, de emprendimiento. Entonces, él nos va a ayudar en esta sesión y lo que vamos a buscar también es que sea algo interactivo. Definitivamente nosotros creemos que la mejor forma para entender conceptos, no solamente en este mundo de startups y de venture capital, es no solamente escuchando, sino aplicando pues lo que van adquiriendo y para eso vamos a incorporar algunas técnicas de gamificación y algunos ejercicios, dos bloques de ejercicios donde ustedes van a aplicar precisamente parte de lo que vamos a compartir el día de hoy. Okay, so Rick, I'm switching back to English. So I briefly shared that like the main objectives of the session and how all this session began a couple of weeks ago
Great.
with Rodrigo. So I guess that it's time to begin the show. The floor is yours.
Okay. Buenos dias, buenas tardes. So yeah, let's go through. Really, we're looking to do a basic introduction of the mechanics of angel investing. And of course, what you're doing is you're buying shares in companies. And it's not dissimilar to, investing in other asset classes like real estate or anything else. And so what we're going to do is we're going to go through and take a look at what you'll be buying, how you value it, how you exit, and what the actual mechanics and the numbers look like. Quick introduction. So yeah, born and raised in Silicon Valley. I'm here in California, Alta California. And I'm an engineer by training. So what you're going to see is a little bit of the nuts and bolts, the engineering side of me that goes through things. I love structure. I love frameworks. I took that knowledge and joined the semiconductor industry. I was part of 3 different startups each one of which started at zero. We grew product lines, became profitable, each one of which became a public company through an IPO, and then we sold them for a collective $12 billion. After that, I became a venture capitalist for a little while. I didn't like it because you're managing somebody else's money. But since then, I've been basically teaching entrepreneurship, innovation, venture capital, and other things around the world. And so it's my pleasure to be here with you guys and teach a little bit about, we'll start with equity math. So let's roll up our sleeves if we can and dive in. Thank you. Cool. Equity math. It's part of and Javier mentioned Strategy Tools briefly. This is the consulting firm that both he and I are involved with. We've been working together for a little over 4 years in this regard. Scale Up Coach is a discussion, and this is a whole series of classes, and you're welcome to take a look online at Strategy Tools. A lot of this stuff is free. You will get copies of all the slides here as we go through. These slides that I'm going to show you are part of my MBA training 20 plus years ago at Berkeley. I had the pleasure of working with Mario Rosati. Term sheets, convertible notes, safe agreements, all these structures didn't come down like the 10 Commandments. They were actually invented by lawyers and people. And Wilson, Sonsini, Goodrich, and Rosati is often noted as the top law firm in the world that has put together a lot of these things. I had the pleasure of taking this course from Mr. Rosati there. These are his slides. So these are the slides where I learned how to do equity math 20 plus years ago, verbatim. And so I always have to give a nod out. Thank you, Mr. Rosati. It starts with forming a company. So if you are 3 people that are coming together, each of which has, maybe someone has an idea, somebody has some money, somebody has some sales contacts, whatever it is, 3 or sometimes fewer, sometimes more people get together and start to go through the process of company formation. This is a particularly important moment. Deciding how many shares and how you split the company is extremely important, because at this point in time, everybody needs a sense of fairness. If somebody's putting in more time, they should get more shares. If somebody's putting in less time, fewer shares. If somebody's only going to be very part-time, even fewer shares still. If you don't have this sense of fairness, fights can happen. And the 2 main reasons that startups break up, one is because you're building something that no one wants. It's an engineer with an idea, but they haven't done their market research. The other is team breakup. So this discussion is super important, and I'll show you at the end of this discussion some resources to be able to figure this out. But let's say that Javier and Claudia and Rodrigo all get together and decide to form a company. Wonderful. Go to the lawyer. You actually now have to structure and incorporate and split up the company into shares. They've decided amongst themselves that equal would be appropriate in this case. So you can split the company up into 3 shares. You can split the company up into 3 trillion shares. But tradition has it between 5 and 10 million. So we're going to pick 6 million, which is divisible by 3. And each of the founders, Javier, Claudia, and Rodrigo, in this case, would be eligible to purchase 2 million shares, divisible by 3. Note that you purchase. The corporation's a separate entity. You don't instantly own. You have to earn your way or purchase those shares. So 6 million shares. We're going to set a low valuation because the company just started. It's not worth much yet. And so in this case, after discussion, $6,000 is the value of the company. And so 6 million shares divisible by 6,000 is 1/10 of a cent per share.
And Rick,
Yeah.
why 6,000 instead of 50,000 or 100,000?
This can be anything, whatever it is you guys decide. If there's anything of real value here, it could be much higher. But honestly, you want to start low because you are purchasing that stock And why set this value artificially high?
Yeah.
There's really no reason. So we start low, and this is actually sort of a key number two. This is very traditional as well, is like a tenth of a cent per share. So there we go. That's called par value at this stage. And note also it's common stock. That means it has no special rights, no special privileges. It's not founder stock. It's anything fancy. So here we go. We're going to go ahead and get together with a lawyer, pay a little bit of incorporation fee, and file. In the United States, you would file with one of the states. So this might be a Delaware corporation or something like that. And here we go. Let's start. Any other questions at this stage? Super early.
No, let's go.
Cool. Let's go. Yes, Rodrigo.
I get a question here. I know some founders that some of them have like a superpower or something to offer.
Yeah.
Besides time, maybe he has like a bunch of clients, or he can get investment, or I don't know. Do you have some guideline to help that kind of founder?
In general, I'd stay away from that. Again, this condition of fairness. Now, if somebody like, we always hear about Mark Zuckerberg and his founder shares and blah, blah, blah. If you really, it is your company and everybody else is going to work just for you or something like that, you could establish founder shares with different rights. It's the exception rather than the rule, because if you have this imbalance of hierarchy, fight, break up. So honestly, if everybody agrees, you sit across the table, shake hands, and agree on some sort of a structure, common stock, boom.
Okay.
Yeah, there we go. All right, so the three of you, Rodrigo, Claudia, and Javier, work away, you're interviewing customers, you're trying to get your prototypes built, everything else wonderful. At this time, you're probably not receiving any financing, maybe some grant money or something like that, but typically founders would max out their credit cards, and Steve Jobs sold his Volkswagen bus, and Steve Wozniak sold his HP calculator, things like that. You just work. Things look like they're happening here. And so now let's take the company to the next step. Next step is maybe you guys are just three engineers and you want to hire some professional management. You also want to bring in me and some other people to help out. Let's get going. So next step would be something like this. This is just an example. Let's bring in a CEO. Rodrigo, who would be a good CEO here? Let me pick on somebody.
Eugenio Godard, maybe he's not connected.
All right. Okay.
I am.
Who's that?
Eugenio.
Eugenio.
Yeah.
Raise your hand. All right. So we're going to go ahead and nominate. We're going to bring in a CEO at this point. We're also going to set up a structure so we can bring in other people. The company's progressed. It's worth more than it was before. It's no longer $6,000. We believe, and this is an artificial valuation at this point because we don't have outside endorsement. We believe the company could be worth $100,000. The other way to take a look at it is, it was a tenth of a cent per share. Let's go ahead and raise the stock price for the next round to a penny per share, tenfold increase. Either way works. What we're going to do is bring in a CEO, and you, Rodrigo and Claudia and Javier, don't give up your shares. You don't split your portion of the company. You still have your 2 million shares that you purchased. And what we're going to do is issue new shares. So we're going to issue another 2 million shares. You can decide whether it's more or less. It's the CEO. And we're going to set a price of a penny per share. So those are worth now $20,000. So the CEO would come in and have the option to purchase those shares. We're also, at this point in time, going to establish something called a stock option plan or a stock option pool. This is the ability to hire other people. Every time you go back to redraw this pie and change the share structures, you have to go back to the lawyers, you have to do filings with the state, everything else. It's expensive. You don't want to do that. And so we're going to establish a stock option plan, in this case, 20%, which is pretty normal. Stock option plans or pools, whatever it's called, is usually between 10 and 20% overall. And you usually do it before a financing. Venture capitalists like to see this already established so it doesn't cut into their shares overall. So again, issue another 2 million shares. So now we have 10 million shares at a penny per share, $100,000. Cool. So the job of the CEO at this point is basically to hire the best people wherever you can find them. And I like that. And to give them the resources that they need to do a really great job. Resources usually means money. So CEO in the group puts together a pitch deck. You go start knocking on doors, find angel groups like you at this stage or investors, and let's go ahead and raise a round. Early stage companies like this, it takes often at least 3, usually more like 6 months. It usually takes greater than 50 meetings. It is a lot of work to raise money early on. But the CEO is diligent, and here we go. We'll go ahead and raise a round. Now, the number here, 50% of the company, is artificial. We've used it just to make the math work. Normally, a company would sell 20, 5, 10, 20, up to 30, maybe even 40% of themselves. They wouldn't necessarily sell half, but I'm using this to make the math easy, equity math. So congratulations, CEO. You found an investor who's willing to go ahead and invest $1 million for 50% of the company. They're buying 50% of the company. So in order to do this, we issue another 10 million shares. We had 10 million before. We're going to double that amount and issue 10. We are establishing a valuation for the company. You take a look here. You add up everybody here. It is $1 million. So it is 10 million shares times 10 cents per share. So the pre-money valuation is $1 million. They're raising $1 million, 1 million pre-money, 1 million investment is a total of 2 million post-money valuation. Talk about that in a second. So this is the math. Couple things here. First off, we're issuing new shares, but we're not issuing common shares. We're issuing a brand new class of stock. This class is Series A, could be Series Seed, but Series A preferred stock. Investors are special. They're not normal people. They get preferences. Preferences in the stockholder agreement that they will sign says that they may have a board seat. They may have information rights in the company, but most likely they will have preferences, which is when there's an exit in the company, they will get their money out first. And for a small exit, that's a big deal. So they could be the one that actually profits more than anybody else ahead of the founders even. So that's Series A preferred stock. Javier, anything else we should mention at this point?
I think that so far it's so good.
Okay.
I'm sure that there are a couple of questions, but I will cover them.
Cool. We'll figure that. All right. So here's some math. By the way, this is called a cap table, capitalization table, and it's a standard form of agreement. You'll find these in Excel spreadsheets where it lays out the shareholders and the stock ownership all along the way. So again, pre-money, when this company walked in the door of the investor, they were worth $1 million. They received $1 million worth of investment. And so the post-money valuation is 2 million. We do a little bit of math, super simple. Before you owned 100% of the company, now you own 50% because you sold half. There's a dilution factor, which we'll talk about in a minute, which means that your ownership again is reduced, and 50% is not normal. Normally, it's between 10 and 40% that somebody's selling. Javier will go through some exercises in a little bit. This is how you do the calculation. So first off, we have to determine for the valuation, what's the price per share? So we take the pre-money valuation divided by the pre-money number of shares. The pre-money valuation is 1 million. Pre-money number of shares was 10 million. And so the price per share is 10 cents. How many shares are we going to issue? We're going to take the proposed investment, which is 1 million, divided by the price per share. So we have to issue 10 million shares. We take those 10 million shares, and if we just want to calculate ownership, this is the simplest example ever, but 10 million shares divided by the brand new total of shares of 20, it means that the investor owns 50%. We'll go through this a couple more times. This is also sort of a cap table progression. So this is the first round that we've done and a way that you would typically fill this out. Good. Cool. All right. So congratulations. You were able to raise $1 million. You take that $1 million and you start working really hard and you put it into marketing and sales. You finish your product development. You get the word out. You hire additional people. The world is a good place. But $1 million doesn't last very long, especially in a high growth startup. So the job of the CEO is to knock on doors again and start raising money. Second round is usually easier because now you have the drill and maybe you have some more traction. So here we go. So congratulations, CEO. You've now been able to find a new investor, Series B, second round, that wants to buy 1/3 of the company for $5 million. So this is more traditional along the way. So your pre-money valuation here of everything beforehand is 10 million. You walk in the door, you're worth 10, you raise 5, and so your post-money valuation is 15. You issue new shares. So we're going to issue another 10 million shares for that. We had 10 before, another 10 on top of that. I'm sorry, we had 20 before, another 10 on top of that means we have 30 million shares. We're going to issue a new class of stock, Series B. Series B may or may not be senior to Series A. It's a discussion that the board of directors has and everything else. But essentially, Series B has different rights, may be able to take their money out first before Series A, may have one or more board seats, may be able to kick Series A off of the board if they wish to do so. So there's a lot of things that happen, corporate structure during this time. Again, $5 million for 1/3 of the company means 15, 30 million shares means our price per share is now 50 cents. Congratulations, the price per share is to continue to increase. Also take a look here at what happens to the founders. Rodrigo, remember back in the day, you had 33% of the company. Yeah. And then you had 20, and then you had 10, and now you have like 7%. Is this good or bad?
It's bad, but good in value.
It's bad, it's good.
It's fantastic.
No, okay, let's break open both sides of the argument. Why is it bad? Why could it be bad?
Because I'm diluting into something that I found.
Yeah, exactly. Your dilution is reduced, and so you had 33%. In some cases, you may believe you had control. But as soon as you take money from investors, you pretty much don't have control any longer. The board of directors now has control over the company, not individuals, even if you have a high amount of shares. Why is it good?
This is a lot of money. It has been multiplied by the 20 times.
Well, take a look. You were worth $2,000. Now you're a millionaire. Millionaire. Whoop. It's nice. The trouble is, so you're a millionaire on paper. Could you take this to the bank and like go get a loan, I'll buy a fleet of Teslas or something?
No.
Nope.
I wish.
Yeah, you wish. So this is tricky. It's called illiquid. It's not sellable on the open market. There's discussion of secondary shares and stuff, but for the most part, it's not sellable. And if the CEO of the company were to do something illegal or the market were to shift, this $1 million could evaporate tomorrow. So it is not solid at this point. It's nice. I remember when this happened to me. I went home, honey, I'm worth $1 million on paper. It's great. So the key here is you can be rich or you can be king. So in here, you're no longer king, but you're $1 million on paper. It's nice. Okay. So congratulations, CEO. You raised $5 million. You start going out and getting doing more product development and increasing sales and expanding to Mexico and doing all kinds of wonderful things. What's next step? Raise more money. It never stops. At least for growth companies, you might be profitable at some point, and so the pace slows down, but really you need to raise more money. There's a bunch of options at this point. You could raise a Series C and a D and an E and an F. I've invested in Series I. It didn't go well. You could potentially sell the company at this point. Maybe you're big enough to be able to have somebody buy you, or you can take the company public. Before we do look at those options, let me go through the math. So again, remember this. So that was our cap table. And then we go through and we look. Oh, no, this is old. I'm going backwards. That's why. Let me go forwards. Forwards is good. Here we go. So price per share is our pre-money valuation divided by the number of shares. We set the price at 50 cents. We take that 50 cents and look at our proposed investment, which is 5 million. So we have to issue 10 million shares. We take our 10 million shares and we divide it by 30 million, the total number of shares now. And so the new investor owns 33%. This is a standard calculation, and we enter those into our next cap table overall. And here we go. So you see it all straightforward. Okay. So options. Let's take a look at what it takes to go public. And this could be a series, instead of a Series C, this could be later on or something like that. But it turns out the mechanics are exactly the same. So a bunch of things happen. First off, we're going to issue new shares. So we're going to float. We're going to go to, the exchange in Mexico City. We're going to go to NASDAQ. We're going to go to the Norwegian Stock Exchange, Sao Paulo, wherever you want. But we're going to float those shares, work with a banker, set the value of the company, do our roadshow, everything else. In this case, we've decided that the company is worth $100 million at its overall value. We're going to float 1/4 of that for $25 million. So we're going to issue new shares. We're up to 40. If you do this math, the price per share is $2.50. It's pretty standard. And you see, so the pre-money itself is 75 million, and the flotation is 25, so a total of 100. Bunch of things happen here. When you go public, this idea of Series Common, Series A, Series B, Preferred, all that goes away. Everybody converts over to Common, and the Common shares are put out on the stock market. What do I want to say here? You take a look here. So congratulations to all the founders. Where you started at $2,000, you're now worth $5 million. This is your money. This is liquid assets. This can now be bought and sold on the public markets. Often for founders, you have to go through a holding period. The holding period might be up to 6 months or something. So they don't want you dumping your shares on the market. But even so, you can go off and you buy your fleet of Teslas. And you can buy maybe a small island somewhere out in the Caribbean or something. Or you can become an angel investor, maybe even a VC at this money. So congratulations, awesome. Also,
And Rick,
yeah.
Before we just go on, why should founders care about an IPO or an exit at all?
Oh yeah,
But
absolutely.
why? Yeah. But why should they care about all of this? So they are just building something great, right?
Okay, well, at the end of the day, you can earn a salary, but this is real wealth. And you can't obtain that wealth. You can't tap into it. Remember the talk about the $1 million on paper? This is no longer on paper. This is actual. This is a life-changing event. And so you as a founder aspire to go ahead and have a liquidity event of this type. If that makes sense.
Thanks.
Yeah.
And the other reason might be that you have some new ideas, but you want to be king again.
This is true. So the world is full of serial entrepreneurs. You know, at least for me personally, I love building companies. I hate running them. And it's a lot more interesting to go ahead and do the early part of the journey, and it can be more lucrative as well in some cases. And so, yeah, go start your next thing, or become a professor and a teacher, like what I got to do. But anyway, this is the way it works. Yeah, you're actually building wealth. Now, the key point of this is not the founder's cool. Congratulations, you did a great job. But take a look here. The Series A investor, what did they come in at? They put in $1 million. And where are they now? 25 million. Is this good? Heck yeah, it's really good. The benchmark for a strong exit is 10x. You hear everybody say 10x. Why 10x? Anybody? Why is 10x a big deal?
It is related with the amount of money that you have invested in your whole portfolio. So that 10x must be related with that company is going to give you back the whole portfolio investment.
Yes, yeah. In general, so it has to do with the risk and high failure rate of startups. So overly simplified, 1 out of 90% of all startups fail. And so one, if it succeeds, needs to make at least 10x your investment in order to break even with a portfolio. So that's kind of it's fund math, and we'll go through fund math in a little bit. But yeah, so 10x. So take a look here at Series A investor. They put in $1 million, 25, not bad. 25x. How about Series B? You put in 5, and here we are at 25. Did they fail? No, it's a little later. So late stage investors, the metric isn't necessarily as high because the risk is lower, but 5x is pretty good. And hopefully they get 2 or 3 more of those and the fund comes together. But 2/3 of all funds fail. I'll get to that in a little bit. But there you go. That's how it works. So that's basic equity math. You just grow, and as long as the company increases in valuation, continues to raise additional rounds, you issue stock at each stage, and then you go ahead and continue to grow the value of the company because other people are joining you, and the pie gets larger. Questions on this? Comments? Get it? Cool. All right, we'll be more advanced in a little bit. I did want to say, this is interesting. How big are the rounds? The first one I said was 50%. That was artificial. These are actual rounds, and so it gives you an idea. But you can see here, it starts off like it's selling 20% of the company and diminishes as the rounds get later. This is dilution. So there's some interesting data. There's all kinds of real great data out there. I'll give you some reports in a little bit. I'll leave you with this on this particular talk is that if you remember the 3 of you got together and decided to split it 1/3 each. This is a way, it's a third-party book. Where is that? There we go. A series of books that talk about how to split equity amongst founders so you get the sense of fairness. It reduces the fighting that happens amongst founders overall, and this is the easiest one right there, Slicing Pie. And I highly recommend it. It's super thin. It's an easy read. Take a look. It's got some spreadsheets in there. Boom. Okay. Javier, I'll let you take it over.
Okay, so I guess that you probably touched about like different types of investors. I think that we'll come back later on to those. But now we are going to switch and we are going to do some exercises, okay? So again, we'll be incorporating some gamification techniques, but this is what's going to happen, okay? So first of all, I'm going to share a board, a Miro board. So this is basically a digital tool that is going to help us to interact remotely. So I'm just sharing a link in the Zoom chat, and you can just click on it and it's going to open your web browser, okay? And you are going to see something similar to this. Just give me a second and I'll share my screen. And what we are going to do right now is that we are going to split the group in a couple of seconds, okay? And we are going to work on, in one hand, we're going to work with the founders on the left side, and in the right side, in the green area, we're going to work with the investors, okay? So that's the reason why at the beginning of the session, we asked you to rename your name in the Zoom session so we can identify you and we can be helping you to move to the breakout room in Zoom. So we have two groups to be able to work on this, okay? And this is going to lead us to this first exercise, okay? So let me just explain what's going to happen in each one of the two groups. So with the founders, what you are going to do now is that here in the blue area, you'll see that there are 8 startup companies. And what we want you to do is that we want you to select one of them, okay, to work in teams, okay? So probably we only want up to 3 people per company. So you just need to add your name here, and that way we know that you're going to be part of that company, okay? So these companies are quite similar. They are part of either the health sector or the clean tech energy sector. It really doesn't matter which one you select at this stage, okay? But this is only to be able to work in teams, okay? And later on in your team, you are going to work on this first deal, okay? Which is basically somebody that you know that is proposing you to invest a certain amount of money, in this case, 200,000, with a pre-money valuation of 2 million, okay? And what we want you to do is that we want you to go through the math and update your cap table, and we want you to find out what's the number of new shares that you need to issue, and what's the total number of shares, and what's the percentage of shares that each one of the different founders and the new investors are actually getting after this round, okay? And on the business angel side, this is what you're going to do, okay? So instead of selecting a startup, what we want you to do is that you are going to be able to select a profile of a business angel, okay? So I think that probably with some of these profiles, we would have like 2 people, assuming that same profile, okay? And you have to do something similar, okay? So you just write down your name here, and that way we would know that you are part of that business angel profile, okay? And the people that actually selects that same profile would be working with you as a team, okay? And then what you have to do is that you have to, again, go through all the numbers and update the cap table of this startup that you want to invest 200,000 at a 2 million pre-money valuation, okay? So it's quite similar, and this is, again, just to make sure that like the pillars of these concepts are understood, okay? So right now, what I'm going to do is that I'm going to open the breakout rooms so we can work in 2 sections. You'll be able to select your breakout room. So please, founders, go to the breakout room in Zoom that it's called Founders. And for the business angels, there's breakout room that it's called Angels or Business Angels, okay? So just please join that one. You can select it. We would also We can also help you and try to move you around, but just as soon as we open the rooms, please help us and join that one, okay? So I'm just opening all rooms. So please, if you can just directly select your room, so you can go to either founders or to business angels, okay? And Rick, would you like to work with the founders or with the business angels?
Let's do founders.
Okay, so I'll jump then with the business angels. So, okay, let me see. And now we are helping all angels to go to the business angels. So you can either select your breakout room or we are sending you to that area, okay? So
Okay.
business angels, Claudia, if you can also help me. Most of the names are already updated and they have an A for angels or an F for, yeah, I see Luis, Vinicius, Angel, Johan, Angel, Peggy, also angels, and I'm going there. So Max, if you can help us and let us know whether you are a founder or an investor, so we can move you to the right breakout room, okay? Question for anybody, either from founders or from investors? And actually, I had one question that was asked in the investors group, and one of them said, "Hey, but we as business angels usually invest through safes. So what happens with that?" Okay, so how do we receive actually shares? Do we receive shares when we agree the terms through the safe? Or when do we actually get some shares, and how do we know the amount of shares that we are receiving? Okay, so I just said, okay, this is something that we're going to cover. So just to have that in mind, okay, which we already had. Okay, so before jumping into this next section, break, let me ask and call out somebody from the Angels that I know that they work extremely well. Luis Rodriguez, sorry to pick you up. How was the exercise? I saw that you did an amazing job. Oh, and for some reason we are not hearing you. I see that your mic is open, but we don't hear anything at all. So,
I think you can hear me now.
yep, right.
So basically, it took me some while to figure out the numbers and the math, so it was not as easy as what I thought, but it helped me to reinforce the session. So thank you for that.
Okay, great. So, okay, break.
Cool.
All yours.
So congratulations, everybody, on going through a little bit of equity math. This stuff, by just through repetition, everything else has become second nature. This is the discussion you often have with not only founders but also attorneys, and you're starting to do constructs. And so, equity math, like the back of your hand. What we're going to do now is we're going to shift gears a little bit. I have two more sessions to give. One is a venture capital business model. So we'll go upscale and talk about the world of VC. And then we're going to circle back a little bit later and talk about safes, convertible notes, and other things like that, and give you a little bit of the structure there. So with that in mind, this is probably about 10-15 minutes of discussion, and hopefully you'll learn a few things along the way. Let's go. All right. This is a typical fundraising ladder. This is the steps that most startups would end up going through, not necessarily each one of them individually, but gives the options all the way through. And this is the classic US fundraising ladder. other geographies or regions may have something different. Often what you'll see in other places is an option right up front called grants. So if your area has a strong grant program or incentives for startups, there might be an incubator less tier in there. But at least within my neck of the woods here, it usually starts off with friends, founders, family, and fools, the 4 Fs. So people are maxing out their credit cards and selling their Volkswagen bugs and doing stuff like that. Whatever it needs to go ahead and get your startup going, you're working through problem solution fit. The whole idea of what it is, what are we building? Let's go interview some customers. Let's figure that out. Let's build some prototypes. Let's get a first revenue in hand. Once you're kind of at that threshold of being able to get revenues, you might be able to join an accelerator. That's a whole nother discussion. They're great options in many cases for early stage startups. And then jumping into the world of angel investors. Angels, non-professional investors, do this as a hobby, part-time, but it's a super important part of any ecosystem. It is the bridge between somebody doing things themselves and doing things with venture capitalists. And we're going to talk about venture capitalists here. And so I'm going to focus on the large ones and kind of give you the model for what's going on there. The startup journey, as they're going through the fundraising ladder, often looks like this. This is a famous diagram. You've probably seen it. Starting here, problem solution fit, go to product market fit as you go through go to market strategies. And then there's this magic day right here where you're break even. You're bringing in as much revenue as you're spending. Hallelujah. Hopefully, as a startup, you get there. That's a day to celebrate. If not, it is called the Valley of Death for a reason. So many startups don't necessarily make it through, and off you go. After you reach that point, you start to climb through the Valley of Death and eventually reach cash flow break even, cumulative cash flow break even, and you're eligible for sort of professional venture capital, Series C, Series A, Series B, off you go. Just the same way we just did the fundraising ladder in the last thing. But before that, here we are, angels and other investments. And so the world of venture capital looks like this. Stefano, do you have an?
Yeah, could you go back to the previous graph?
Yeah, sure.
Sorry, you mentioned 2 times the break even in the Valley of Death and after the Valley of Death.
Yeah.
But I didn't understand the difference.
Oh, that's sorry. I used the same term 2 ways. This is that one day that you're able to bring in as much money as you're spending.
Okay.
So that's that break even. This break even right here is, let's say you've raised money or you spent money. Now this is the time at which you've actually cumulatively done that. And so if you raised $1 million, now you have $1 million worth of profits. And so boom, you're break even. You crawled through the real Valley of Death, and now you're on your way to become a profitable concern.
So to being eligible for any professional VC, you should be like accumulatively break even, right?
This is it's not a religious rule. It's
Okay.
somewhere in here. To be honest with you, I have another diagram I could pull up, but if you're familiar, there's a school of thought from Lean Startup called the 4 Steps to the Epiphany, and it goes through if you're figuring out what your product is and you're kind of developing problem solution fit, you're pretty much not eligible for venture funding unless you've had a really good track record. As you get farther along and you get to repeatable revenue, so you know what your customer acquisition costs are, you know what your customer lifetime value is, you have a good sense of it, that's the point at which you pretty much can start to seek professional venture capital. And I'll talk about why in a minute, but venture capitalists, well, I'll do it right now. Venture capitalists are middlemen. All they do is they take somebody else's money and they go off and they find entrepreneurs. And they don't want to do that if the value proposition for the entrepreneurs is too risky. Angels have a higher risk profile than venture capitalists do. And so it's pretty much the point, at least for me, I always look for, if I'm talking to VCs, it's product market fit. And if you achieve that, then you're now dealing with this class of investors.
So when you have proved the product market fit and you're starting to have revenue and you're starting to be adopted like in a more accelerated way, then
Exactly. And
okay.
so I'll get this, the simplest example is, okay, you know what your customer acquisition costs are. Let's say it's $10. I spend $10 in marketing sales, I can get a customer. Now I can raise $1 million and get 100,000 customers. So it's that kind of equation that
Okay.
makes this value proposition a lot more solid.
Understood. Thank you.
No problem. Thanks for the question. But so who are these people? Well, they basically raise money from somebody, these big funds, I'll show you that in a minute. They take that and then invest in entrepreneurs. Hopefully contribute some value, sit on boards, help with strategies, hiring plans, everything else. Entrepreneurs also get customers, companies, and maybe some funding from government, who knows. But this goes on for a number of months, years, whatever. Then the other side of the equation comes in. When it's time to do an exit, venture capitalists will then retain or bring in some sort of an investment banker to go through the IPO process, or to try to sell a company and to go off. And so you're selling it to floating it on the public market, or selling to a corporation. So again, they're middlemen. They basically facilitate this funding, growth, and then bringing in an exit strategy.
Mr. Rick, what IPO stand for?
Oh, I'm sorry. Initial public offering.
Initial public. Thank you.
Yeah, no problem. It's the flotation of the shares on the public markets. And so these people, and I'll go back, sorry to skip around. These people here are limited partners. So your limited partners are these typically very large funds, big pools of money, pension funds, university endowments, sovereign funds. Actually, this is an older slide. Those funds are actually probably twice this size at this point. Big deals. And so these huge funds are buying and selling real estate, stocks on the public market, trading bonds, public foreign currencies, all kinds of things. And they also oversee a slice of their portfolio on a high risk, high reward equity class called private equity, asset class called private equity, hedge funds, leverage buyouts, venture capital. And so these are the risky ones. And typically these huge funds will take maybe 10, 15, 20% of their portfolio and invest as a limited partner. The way this works is, number one, if you and your friends or your colleagues wanted to start a venture capital firm, the first thing you would do is you would sit down and decide amongst yourselves what is going to be the largest potential investment in startups or scale-ups that you can do over the next 10 years that would beat the Fortune 500, that would beat the S&P 500, that would beat the overall markets. You're trying to figure things out. And so you would select a sector and a stage. A sector might be ag tech, or artificial intelligence, or biogenomics, or something like that, where you believe that this asset class will outperform others. And you also specialize in early, mid, or late stage investments. Each one of those is a different profile. Remember Series A and Series B investors in the last class. Are you willing to take the risk as a Series A, or you want to sort of be more risk averse as a Series B investor? So you put together this thing called an investment thesis, which is a big binder full of what you believe. It's your hypothesis, and you start knocking on the doors of the various limited partners. Knock, 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 and you try to see whether you're able to raise a fund. A classic fund, large first-time fund, is maybe $50 to $100 million. So it takes maybe a year, and then you're able to go ahead and get a commitment from these people that they will allow you to invest on their behalf up to maybe $100 million. So you have general partners who run the fund, and then venture partners who are typically your industry experts, associates who are the young MBAs that eventually someday want to be a venture capitalists, and maybe some fund managers on the financial side. And you put together a VC firm, that's the company, under which there are funds. So I'll show you that. And the job of the fund is to find opportunities, find startups to invest in, and generate returns. So a fund looks like this. It generally takes about a year in good times to raise a fund. I'm in the middle of one that's already in the second year trying to raise those monies. It's a difficult time right now to do that. But when the fund is established and incorporated, and they're usually a partnership, not a full corporation, they're typically 10 years in duration. So the first part of that, 3 to 5 years, is the investing period. You get these commitments from limited partners to invest on their behalf. You invest in startups. And then the last part of the fund, 5 to 7 years, is the harvesting period where you create value and you try to push them towards going public or be sold. And that's your outcome. 10 years is very typical. It could be longer if it's a long, like pharma or something that's going to take longer overall, but this is pretty standard. If you're successful in the first part of it, many firms raise a second, a third, a fourth fund, and they're typically named like this. So fund number 1, LLP, limited liability partnership, or 2, 3, 4, 5, all the way through. And that's the firm. So how they make money is twofold. Number one, they receive a management fee. So they're managing the $100 million worth of potential assets. It's called committed capital. The $100 million of committed capital on this behalf, and they would earn 2% per year in order to run the fund. So this is where they get their the nice office, the fashion models at the front desk, the Teslas that they're driving, all that kind of stuff. And so that's $2 million a year, which is not a lot considering, if you have multiple people as partners, but it pays the bills. And then the second thing, and this is where they really make money, is your job is to find individual companies to invest in. If there is an exit, those exits can be large, and you split the profits. Now it's their money. So they get 80% of the profits and you get 20%. But that can be big. I'll show you the math in a little bit, but that's how it works. So management fees and profits, 2 and 20, 2%, 20%. And this is called carried interest. So you'll hear that term a lot. So here's the job of a venture capitalist. When they show up at the office, this is what they do. First off is to source deals, to find the best deals possible. And so if you're a first-time fund, nobody knows you. So you have to go off and market yourself. You have to go to conferences and find the best deals. You don't invest in everybody you meet, nor will you. And so there's some sort of an investment process that people go through and actually place investments. And once that's not where it stops. The good ones actively manage their investments and they create value overall to try to actually, turn their, like we did before, the Series A person, their $1 million into 25 million. You're trying to do that and then push towards an exit. So this is the math typically of a venture capitalist. They'll take a look at a typical partner, just one person in the firm, will take a look at about 1,000 deals a year. Pretty common. So that's 3 a day, 365 in a year, 3 a day. And a lot of them are junk. You just throw them away, but then you actually sit down, you take some of them seriously, and you might meet with 100 over the course of a year. That's 2 per week. That's doable. Oops, sorry. It's not a party. This is serious. But you march your way down. Out of the 2 a week, you meet with maybe 20, or you go through the due diligence process, and then you meet with the other partners, and you actually go through and negotiate a deal. And then so you typically only do 1 to 3 per year per partner. So you can see that the pipeline is pretty narrow at the bottom. So they're off looking at deals. This is what they do. They go talk to leading industry experts. They go to incubators and accelerators and co-working. They meet with people like you. So they're interested, what have you found and what are you investing in? And they're going to be the next round. This is important for you because this allows you to create value and all the way up. And so out of 1,000 plans, 1 to 3 investments, and you may, as a venture capital, sit on a board. Board work is hard. If any of you are on a board of directors, you know that if you take it seriously, you're out there actually speaking with a company, fixing problems, working on strategies, helping them out, reviewing reports, getting all the legal stuff done, blah, blah, blah. It's work. And so the capacity of a typical VC partner is maybe 4 to 8 boards to sit on and to actively manage things. It's committed capital. So VCs aren't banks. They have the ability to grab money and make investments. And so when you're ready to make an investment in a company, you put out a capital call to the limited partners, say, hey, we need $10 million. And they'll wire that to you. If they don't wire it to you immediately, you basically have to have a line of credit and you borrow on that. You make the investment. So there's a little bit of financial management that goes on. Now, you've looked at 1,000 plans, you've met with 100 companies, you've made your 1 to 3 investments per year, out of which maybe you make 10 over the total, you as a partner, total lifetime of your fund. Every single one of those is handpicked. Every single one of them, you want it to see at least 10x potential. But in truth, this is the outcome. And this is pretty statistically valid. So out of your 10 special, they're special. We love to watch this. There we go. Out of your 10 special investments, you do, 3 will die. 3 will die. 3 will sleepwalk. They're like zombies. They don't succeed. They don't fail. They're zombies. 3 might return money a little bit, 1x, 2x, 3x, but that's not good enough. And then 1 would be your skyrocket, at least 10x or better, hopefully. These are statistically valid. But let me ask you 2 questions then. One is, which is worse, to die or to sleepwalk? Anybody? Here's a shot.
I do have an opinion, which is the cost of opportunity when you have one company sleepwalking.
Yeah.
Like you're going to spend that time instead backing your skyrocket company, right? Or your return money.
Yeah.
Cost of
You're exactly right. You're exactly right. And the word is time. We're only on this earth for so long. Do you want to spend your time going to yet another board meeting where you hear these losers talking about the fact they didn't meet their sales quota, so you have to fire the VP of sales again and get somebody else on board, and it just doesn't go anywhere? No. VCs have a reputation to actually kill these companies. So this is where they starve them and they don't let them raise another round and they just die. They basically force them to die. So sleepwalking is the worst. It just takes time. Question number 2. 2/3 statistically valid, so maybe as many as 3/4, 2/3 of all VC funds don't even make as much as an index fund, a market index fund. Don't even make as much on average as 7%. They're failures, 2/3. Why is that? Everybody thinks VCs, oh my God, VCs.
It's actually hard.
It's hard. Why? But the answer is here on this diagram. Why are 2/3 failures?
Because they don't get that return money companies. They don't get the skyrocket companies.
Yeah, exactly. These are statistically valid, but only, this is the one. If you don't have this in your profile and it's 1 out of 10, it's kind of luck in some ways. Look at the rest of it. It's just junk. And so you're not even going to make as much after your management fees and everything else as putting your money into an index fund. So venture is hard, but it looks like this. I gotta fix my diagram here. But it runs on something called the power law. By the way, if you're interested, this book is awesome. The power law. It really goes through Sebastian Malady. There's the guy. it really goes through and describes this in detail and uses Sequoia Capital as their proxy in a lot of the arguments here. But if you don't get those hits, you don't make it. So venture is a hits-based business. It's just like movies. So if you're out there putting on boring rom-coms or documentaries, you're not going to make a lot of money as a movie studio. It's like games. If you have that hit game, great. If you're just going to put out generic, another silly app that people don't really take advantage of, you're not going to make money. Venture's the same way. You relies on hits. And so therefore, only the few that are really the hit makers really do well. Yes, sir.
Yes, hello, Rick. So taking that in consideration, the distribution of the return, what could be like a good advice or a good considerations for angel investment? Because as an angel, you invest in a single one-per-one company.
Yeah.
So that means that you don't get to get this opportunity of distribution. That means that you are very lucky, or you are very, very intelligent, and very experienced, or you make enough single angel investment to actually kind of look like this distribution. So maybe what's your opinion?
Couple things. So first off, the distribution will be kind of the same, to be honest with you. So that's your expectation going in as an angel. I'm an angel. I like it. I enjoy meeting with companies. I enjoy the company of my fellow investors. I'm part of a club like you guys are. It's cool. It's fun. And my expectation to make a lot of money, in general, I'm a little bit better than break even overall. So I've done okay. I haven't done this, but this is not my primary living. So you may get lucky, but don't necessarily depend on it. The expectations shouldn't be there necessarily. But I hope that you beat the averages, and that's kind of what you're looking for. Yeah, and you want to do things that are statistically significant. So just if you do 2 or 3 or 5, cool. Then you'll probably see something like this. But if you're say 20, 30, something like that, statistically significant, you'll be statistically significant like this.
Okay, but it is not the case. It is not necessarily the case that it is better to actually put your money as a LP in a very small fund, a very small firm, rather than put your money directly to one per one company, or is not necessarily the case.
Okay. So I can't answer that for your geography, but what I can say is that as an angel, I think it's more fun really to honestly deal with the individual companies and the management and their journeys and help them out early on and stuff like that. And so it needs to be socially rewarding as well as hopefully financially rewarding. Yeah.
Thank you.
And Rick, you also need to take into consideration the access to the deal flow, okay? Because probably, a fund, it's a lot more well connected to the ecosystem than an individual business agent, okay? Unless you are really well known and well connected in the ecosystem.
Yeah, but I would say that being part of an angel group really helps the deal flow.
Yeah.
That was the reason I joined Sandhill Angels for me and helped. And so we were looking at 100 deals a month, and we actually had, those were all sifted down to 3 at the end at our dinner meetings. And so I got a chance to see the best and go ahead and make my investment, and also listen to the wisdom of the crowd and other people's opinions, and have some help with due diligence. So actually, in some cases, for super early stage investments, angels have it better than VCs.
Rodrigo?
Well, I have like a little thing or two to say. I mean, that's what I do. So what I think is we give you, as Javier said, we give you deal flow, we give you due diligence, and when you invest in group, when everybody has interested aligned, we have like everybody's resources, network, and that help each other. As I understand, Rick belongs to some group that, well, we have these opportunities. Where do you want this? Do you want that? And everyone decides individually. When you are a part of a group as a BC, they all work together. So I think it's like the power of the whole crowd helping each other.
Yeah. VC is absolutely true. 100% believe everything you just mentioned. VC though, once you get a little farther along, it's competitive, so people are fighting for deals. Angels, it's not that way. You know, you typically angel groups are collaborative, and everybody's in it for, you know, different reasons rather than just strictly competitive fighting, maximizing their percentages and potential gain overall. So, no, I think at your level, you have a really good chance to do better than beating the odds of what a venture capital group would do, if that makes sense. Cool. So, anyhow, so this lays out sort of the landscape of venture groups. We've been talking about this traditional model, you know, which is something of critical mass, professional investors, taking, you know, take at least 10 or more investments in the fund, typically, you know, up to 10 per partner, actually. Ownership levels are higher, and there's active financial management. If you're dealing with small funds of $2, $5, $10 million fund, they're smaller. It's more difficult. They take smaller scales. It's like the step up from an angel group. It's like maybe a super angel almost to a small fund. Accelerators, most accelerators operate like small venture firms. So they have a fund, they invest. It is a small amount, typically 120,000 is nominal, plus or minus, for 7%. That's the typical Y Combinator formula, or Alchemist, or 500 startups. And they do they occupy the spray and pray model, which is a lot of investments and pray that some of them come back statistically. CVCs, corporate venture capital, is a big deal. Looking for both returns, also strategy, and you'll find people on all ends of that spectrum. And then impact, looking for people, planet, profits to make a difference in the world, more as much as making money as well as you go. So there you go. So here's the world of venture capital. So basically, a venture capital firm tries to attract investors, knock, knock, knock on the doors of all the pension funds, build a portfolio, focus on value creation, generate some returns, and then go back and hopefully do the same thing and raise multiple rounds, multiple funds. There's a lot more to this presentation with all the financials behind it, but I know we're limited on time, and so I'll give you guys the entire presentation. You'll have a chance to go through it.
Great, Rick. So what should we do? I mean, shall we just describe what happens with the safe and a convertible note with an example, or would you like to talk a bit before that?
You know what? Because I can just show like 2 or 3 slides and get the point across, and then yeah, we'll do that. And then Javier, other than that, what else would you like to do with the time remaining? Do you want to go through another exercise?
Yeah, probably we can continue the explanation about safes and convertible notes, and probably we can just work on the exercise as a group, okay? As we are now a smaller group, and just explain them what actually happens, either from the founders' perspective as well as from the business angel one, okay?
Okay, let me go. Thank you.
Yep.
Thing. And then share slides. Here we go. Cool. You've seen that. So we're going to talk about the structures within the actual the mechanics of how to do this. Promissory notes, convertible debt, convertible notes, all the same thing, or safe agreements. That you know. Oh, and basically these structures are reserved for this before we get into actual priced rounds. So what you're trying to do is to, with these structures, you typically are looking at a point where you're avoiding valuing the company. It's too small, it's too early, it doesn't have steady stream revenue, Maybe you can try to peg a value, but if you simply want to get a deal done quickly, easily, minimize paperwork, go ahead and place an investment. Maybe there's multiple investments coming in. That's these two mechanisms, a loan, which is like a convertible note, or actually provide something called a simple agreement for equity. You set the valuation later, and you convert to equity when the value is set. And then when the value is actually setable, you have a comparable, the company is more steady state. There's other investors that come in and want to maybe help set the value. You can do a priced round. So you have the option. You can do this early convertible note or safe, or you can typically do a priced round. Sandhill Angels does both. But know that typically it's a two-step process if you wish to do that. One of these, and then moving on to equity. And so here's the map. If is it a significant investment? If it's small, that's fine. In terms of dollars or percentage of the company, if it's yes, can you establish a value? Yes, then let's go ahead and do a term sheet and fill the whole thing out, get the lawyers involved, negotiate it, done. Maybe even take a board seat, who knows? But if it's either small or you can't establish a value, then if you want to do a loan, then you do a convertible note. If you don't want to do a loan, it's a safe agreement. It's as simple as that. So the loan expectation is the company has, if you have a termination date of like 12 months, 18 months, 24 months, you expect the company can pay you back, do a loan. If you think it's super risky, it's either yes or no, it's a binary outcome, do a safe. That's it. Make sense? Okay, cool.
And then, Ray, just before continuing this, also the convertible note has the advantage that later on you can decide whether you want to convert to equity, right?
Both of them do. Both of them are convertible into equity. So from that side, the back end looks exactly the same for both.
So what is the main difference between convertible note and safe then?
That's it. It's just whether it's a loan agreement.
Okay.
That's it.
You have to pay the interest in theory.
Right.
Yes. And so with a loan, you have interest. I'll go through that. You'll see. Safes are pretty common all the way throughout. And so you see here 98% of media companies, education companies, and so on, as you get into medical devices and things that are a bit more asset-oriented, loan-ish, maybe longer-term investments and things like that. You get, like pharma, biotech, and things like that. You still have a preponderance. This has changed over time. A decade ago, it would have been mostly convertible. Now it's mostly safe. They're just easier. Okay, here's a convertible note. It's a loan. So it's got an interest rate, has a maturity date. It has typically, because you're going in early, you get rewarded because your risk profile is higher. So you get rewarded. It's typically a discount most of the time. Sometimes you get warrants, which are the ability to purchase additional shares, but you get a discount. So if the price round later on is $1 per share, you get it for 80 cents. Cool. It's a loan, so it can be repaid. Typically, it becomes due in 24 months, and so I expect to be paid for the whole thing. If it's some company that has actual revenue flow, you can structure it as an amortized loan, which is regular payments, like a car loan. And if they want to pay in advance, that's cool. So it's a loan until it converts. A safe is not. It was invented by Y Combinator. It's not a debt. It may have discounts. It may or may not have caps. I'll talk about both of those, and I'll go fast. So here's the typical convertible note, and so here, price per share without a discount. With a discount, it's 20% off as you convert overall. And so if you were to get 1 million shares under the earlier condition, you get 20% more shares. That's cool. Or 25% because of the discount, 20%. And there you go. And that's how it changed. So there's an advantage to that. And super quick, the other thing that people always talk about with these types of instruments, both a note and a safe, is a cap. What a cap does is basically establish a valuation. If the company is a runaway success, your ownership as you convert will drop significantly. And so you establish a cap so your ownership gets fixed at some level, usually 5 to 10 times where you invest. And so I'll show you quickly what that looks like. So here's a $5 million financing. You provide a note for 500K. The post-money valuation is 5 million. So we're going to use 5 million for a calculation. And so if the conversion takes place at a $5 million cap valuation, your percentage ownership is fixed at 10%. 500,000 into a $5 million post-money valuation is your 10%. Hang on. Do you hear my cat over there? It's yelling. I'll have to get that in a minute. If the financing goes to 20 million, if it's a runaway, hey, if you go ahead and convert, you're no longer a 10% owner. Now you're at a 2.5% owner. This could be bad. And so what a cap does is basically say it's a 20 million financing with a $5 million cap. You actually run the numbers based on the financing actually happening at 5, and so you retain your percentage ownership. And the cool thing is that you take advantage of the increase in value of the company. So it's a runaway success. It grew by 4x. Therefore, the value of your stock is actually 4x what it was. So you have the same number of shares, but you take advantage of that. That's what a cap does. It's a good thing for the investor. It's not necessarily a good thing for the company overall because they provide more shares for the 500,000. That's it. I have other things. Let me just show you what I have, and then I'll move on. Javier, I'll turn it back over to you. Convertible note has certain outcomes. You can, if there's an exit before it converts, it's you get your money back and more. If it converts, all good. That's what it's supposed to do, and you get shares in the company. If the company does not convert at the point of maturity of the loan, if it's a year or 2 years, you have to figure it out. If the company fails, then it dies. You maybe get to go through bankruptcy court or something like that. It's nasty. So it's like a default on a loan. So that's why this can be ugly. So it can be good, medium, or not so good. And that's the deal. Here's a safe. Basically, if it fails, it fails. You don't have recourse. That's the big deal. There's multiple versions of it. This is most favored nation, which means if they raise money at a lower valuation, then you get to take advantage of that too. And those are the exits. You see, it's just simpler. That's all. Those are the outcomes. It's simpler. And I'll leave it at that. Any questions? So sorry, I went through that pretty fast. Any questions on that?
Please.
Go ahead.
Great presentation. Thank you.
Thanks. Thank you. Couple things. So it is simple agreement for equity. It is simpler. Number two, there's standard agreements out there on the web all over the place. My recommendation is to go to Cooley. The Cooley is a law firm here, Cooley.go, and you can pull up all kinds of standard agreements. Founder Institute is another place to go, and they have great stuff. But I'm sure you as an organization should just adopt one that you feel comfortable with and try to work with companies. They're all pretty simple and standard and can get signed and negotiated and signed, very quickly.
Right. Thanks, Rick. So, Rodrigo, I was just checking the time that we have left. And so probably we could skip the last exercise and just mention that this is like a a brief introduction of a program that we've run in other regions and the program in person that we are trying to bring to Mexico. And probably it could be interesting to show them what they could expect if this happens this year, okay? What do you think? Shall we just mention that briefly and then we can move to the poll and to the closing?
Yeah, sure. Let's do that.
Okay. Then let's just, let me share this. Give me a second. And Rick, I'm going to switch to Spanish. I think that this is going to be.
Yeah, for sure.
See.
100%.
Okay. Just give me a second because for some reason, yeah. Okay. Listo, nada más para confirmar si ya está la presentación, ¿verdad? Y como comentabas hace un momento, esta sesión, algunos de los elementos que ustedes vieron forman parte de un framework, un conjunto de herramientas y un enfoque que hemos estado utilizando, ya sea con startups, también con quienes quieren lanzar un fondo de capital de riesgo o con grupos de ángeles inversionistas en Europa, Asia, África, Estados Unidos, y queremos precisamente ahora empezar a utilizarlo en Latinoamérica, ¿ok? Y esto lo que busca es que tanto fundadores como inversionistas entiendan cómo funciona el viaje completo de escalamiento precisamente en este mundo, ¿ok? Y lo que buscamos es que ustedes tengan acceso a herramientas visuales sencillas a través de algunos elementos de técnicas de gamificación para que en lugar de que tal vez tomen algunas decisiones sin entender las implicaciones hacia el futuro, sobre todo, lo puedan experimentar precisamente a través de estos elementos con técnicas de gamificación. Y si se equivocan, no pasa nada. Y eso es una gran herramienta para que ustedes puedan, uno, aplicar precisamente algunos de los elementos que ustedes van a encontrar a lo largo de su viaje precisamente de escalamiento y que también nos sirvan para compartir ejemplos y experiencias de qué es lo que deberían de hacer o qué elementos deberían de considerar cuando tomen una decisión, cuando busquen un cierto tipo de inversionistas, cuando desde el lado de los inversionistas pues vayan planteando dónde quiero invertir, cómo tengo acceso a mi deal flow, etcétera, ¿ok? Entonces, eso es lo que buscamos y precisamente en 3 días lo que buscamos es que pues ustedes experimenten precisamente todo esto. Típicamente estos son algunos de los temas que se contemplan en una sesión en persona de este tipo. Algunas cuestiones básicas, tocaremos tal vez algunos de los elementos que el día de hoy discutimos para que podamos obviamente pues correr en las siguientes sesiones, en los siguientes días. Pero esta es típicamente una estructura de esto. Y obviamente ustedes tendrían acceso a todo lo que es el toolkit, ya sea desde la perspectiva del equipo de fundadores o de como ángeles inversionistas, a varios elementos visuales que han sido diseñados precisamente, especialmente para startups o para inversionistas. Y estos son algunos de los elementos gráficos visuales que son, la verdad, también es muy divertido porque no se dan cuenta y van aprendiendo a lo largo de las diferentes sesiones. El contenido está basado en situaciones reales, en startups reales, en fondos reales, en inversionistas reales alrededor del mundo y eso también lo hace que sea muy real y que las experiencias obviamente sean muchísimo más significativas, ¿no? Hay diferentes industrias, diferentes etapas del viaje de transformación y no solamente vamos a estar hablando de la parte de qué sucede con las acciones y cómo funciona en las matemáticas de esto, sino vamos a tocar también puntos de cuál debería ser la estrategia de un startup, por qué deberían de estar considerando la parte de eventos de liquidez, cómo pueden ir estableciendo precisamente vínculos para en algún momento en el futuro, pues tener una ruta clara para este evento de salida, porque a final de cuentas, si deciden entrar en este mundo de levantar capital, sus inversionistas necesitan saber que en algún momento van a obtener precisamente liquidez de sus inversiones. Algunos ejemplos de con quienes hemos estado colaborando con este enfoque, aceleradoras, agencias de innovación nacionales, asociaciones de ángeles inversionistas o de inversionistas en algunas otras regiones. Y esto otra vez, o sea, es algo que hemos utilizado en más de 300 sesiones alrededor del mundo con estas precisamente elementos. ¿Vale? Así que es algo que esperamos precisamente, estamos trabajando en ello en conjunto con Rodrigo, con Gabe, para buscar de qué manera lo podemos realizar a final probablemente de este año. Hay cosas que tal vez ya no nos dio tiempo de cubrir. Como mencionamos al inicio de la sesión, vamos a compartir el video y también van a seguir teniendo acceso al tablero de Miro si quieren regresar y quieren ver algunos de esa información que el día de hoy discutimos, o algunos de los ejemplos o algunos de los casos, los ejercicios que también fuimos explorando, ¿vale? Rodrigo, pues muchísimas gracias por la sesión. Veo que Rick está, you're fighting with your cats.
He doesn't like it when I'm on. No,
Ok,
all right.
muy bien. Rodrigo, pues muchísimas gracias. Te regreso la palabra.
Gracias a ustedes, Javier. Pues bueno, estaremos de regreso con ustedes para hacerles propuestas para cuando podamos hacer este evento, idealmente en persona, y poder tomar un curso más en forma y más a profundidad, para tocar estos temas, y vamos a aprender un montón. El día de hoy fue una muestra.
Exactamente. Pues muchísimas gracias a todos y
Thank you.
nos estamos viendo
Gracias.
pronto.
Muchísimas gracias.
Gracias. Nos vemos.
Gracias.
Hasta luego.
Gracias. Hasta luego.
Yeah.
Luego.
Adiós.
Bye. Adios.
I don't know who's there. Yeah. Thanks a lot, Rick. It's been fun. I'll go back with Rodrigo. You have some
Cool.
feedback, and I'll come back to you as well.
Good. Hopefully mission accomplished. I hope that went well.
Yeah, it was fun.
It's good. I'll send you the slides.
Yep. Thanks.
All right. Glad you-
Okay.